Hello everyone, welcome to my channel. Uh, so in this video we are going to do intrinsic value analysis of Bank of America stock. So first of all we should go to Yahoo Finance. In Yahoo Finance, once you go in, you can search BAC. BAC is the ticker for Bank of America Corporation, right? So as of September 11th, it is trading at $25.5, right? And this turns out to be a market cap of $220.9 billion. So which means if if we have to buy the whole bank, we have to pay $220.9 billion. Now, what we want to see is this the price $25.5 the right price to buy the stock or not, right? And for that, we need to calculate the intrinsic value of Bank of America. What intrinsic value will give us is it will give us the amount of cash that we can get out of Bank of America for a designated period of time, say 10 years, right? And if we are able to get a lot of money out of the bank, then it means that we are doing a good investment by buying the bank, right? So let's see. So for that, first of all, you have to go to cash flow statement, and there are different items in the cash flow, right? So here, what I want you to focus on is the net income and the depreciation and amortization of the bank, right? So net income is the income that the bank is making, and the depreciation and amortization is the depreciation of the assets that the bank has. Now I'm going to show you a very straightforward way to calculate the intrinsic value. So what you need is you need to open Excel, and let me write Bank of America intrinsic Bank of America Corporation stock intrinsic value calculation, right? For banks it's very straightforward. So what you do is you write the net income, and then you make a tab for D&A, right? The depreciation and assets, and both these values will be in billions of sorry billions dollar. This one will be $1 billion too. So for, let's say, 2020, you can write year here, 2020 net income is showing around 20 billion, right? So I'll just put down 20 here. The intrinsic value doesn't need to be very precise, you just need to have an estimate that how much some asset worth as of today. And if you have a big difference between the price and the asset value, then you can buy the stock, right? Then it will be a good investment because you are buying the whole business or whatever part of the business at a discount than what it's worth. And now the depreciation and amortization, it's around 2 billion. We'll put it to. There is another thing that comes in most of the companies, which is capital expenses. But for banks, generally, there is not a lot of capital expenses year over year because the banks are already established, and they don't really need to invest. They may invest in some technology and stuff, but that's not a lot compared to a automotive industry where the machines break down, and then They have to, go and do capital expenditure to renew the machines, or they need to do the maintenance of the machines. So all that is not really there in banks. It's mostly the salary of the people, right? Not, and that doesn't fall under capital expenditure. So what is the cash that the bank is producing? It would be the sum of these two at the end of 2020, let's say, right? Oh, sorry. I should change this so that I have a formula. And then we can go backwards. 2019, you have 27, and this you have again around 1.7, 1. So I can just make it 2, doesn't really matter. 2018, this is just, I'm showing you some examples. So 2018, it is 28, and then this is around 2, right? So looks like the income is decreasing, but that's not the case, because right now under corona they have some reserves, right, in their account for like loan defaults. So the bank is reporting a lower income because they are keep separating some of the income as reserves. So it's not actual loan losses, it's just that it may have some loan losses, right? So the next thing that I want to show you is there is a very good website called Macro Trend, and in Macro Trend you can go to Macro Trend, go and search for BAC there, and you will see this tab open up, and then you can go to financials here and then go to the balance sheet. What I want to see is what how this bank is doing. Sorry, you have to go to the income statement basically, and over time, right, we have to see how whether the income is increasing or decreasing. So the best way to see that is look at the operating income, right? Operating income usually doesn't take care of, like, doesn't get fluctuated with a lot with like current events. It gives a true representative of how the performance is happening. So you see, this goes back to 2006. That's a long time ago. So Bank of America was doing good around that time. Then the financial crisis came. The income reduced. Then there was losses. Then they started the recovery process. Brian Moynihan was elected as the CEO around like 2010, 2011. And then the recovery started, and now since 2015, you see the bank is making some money, right? This recent one has decreased a bit, but that's just because of the coronavirus. I think it's temporary. Once the economy is back, the bank is going to make more money, right? So the operating income is increasing. So what we can do is we can look at 2015 income, which is around like whatever, 13 billion dollars, right? And then we can see it has become up to like even if you take this income like 23 or 20, let's say 28, that's more representative. You can go to a compound interest calculator, right? And you can go to MoneyChimp, and then let's say 12, you can put here 12, that's the current principal. And then the years to grow is, we are taking from 2015, so like 5 years, 2015 to 2020. And you can pick an interest rate, like let's say I picked 7%, right? Let's see. So it is showing the future value is 17, but what we want is we want to match this like around 23, 25, 28, whatever, roughly, to see at what rate the income is increasing of the bank, right, over last 5 years. So we are going to do say 12%, and see now it's around 21. we can say around say 14%, 23. Let's pick 14%, right? So the bank had a lot of issues around 2008-9, then it recovered, and now what? Now it's like growing. It's growing its income around 14%. Another way of looking at it is going to Yahoo Finance, go to analysis. Usually these analysis are okay, but it's not, you know, it doesn't tell the full story because they are too fixated on the fancy stocks like Tesla, Apple, etc. So for Tesla and Apple, it's good, but for value stocks like the banks and for like Johnson and Johnson, etc., they don't truly represent anything. So we'll stick with this 14%. That I think that's more realistic because that's based on actual data from the past. So this is our cash flow. Basically, this total, or I can say this is the cash flow from the business to the owner, right? That's in $1 billion again. So basically this cash flow, because the net income is going to, or the income is going to increase, this cash flow is also kind of increasing, should increase in same way because the DNA is small. So what we can do is we can now basically put down some years here. We should do this for at least 10 years. 10 years is a good time frame, and the banks, oh, this Excel didn't take it properly. So let's see, let's try again. 10 years is good time frame for banks, um, and any other value company because they slowly build their business, and in 10 years you can basically look out 10 years and see how things are, right? So I will take cash flow here, right? And I will start with 22. I want to be a bit conservative. And I'm going to commit that this the cash flow is going to increase at 14%, right? For let's say 5 years from here. So which will be around 2025, let's say, right? And then so what I did was like I basically took, you know, this cell and multiplied that with 1.14 because I said it is going to grow at 14%, right? So basically 100 becomes $114. Now beyond 5 years, let's say we don't have the visibility that what's going to happen at the bank, right? It may grow faster rate, same rate, or lower rate. What we are going to do is we are just going to be a bit conservative. It's always good to be a bit conservative because then you will have a big margin of safety. So what I'm going to propose is it's going to grow at after 5 years at 10%, right, instead of 14%. So for the next 5 years till 2030, I have grown this cash flow at 10%. Now here is the key part. We need to discount this cash flow, which is again in $1 billion, to present value. What that means is, say you have $100 today, right? That $100 is not same as $100 for, which you will have in 3 years from now, right? Because there will be inflation. So the things that you can buy with $100 today may not be possible to be bought for $100 in 3 years, right? So we have to adjust for that. And typically, if we are looking for a 10% return on our investment, right? So we have to discount that with 10%. So that's a lot because you see if you put your money in the bank today, they are probably giving you 0.5 to 0.7%. Even the 10-year treasury is trading around 0.7%. So in comparison, 10% is a pretty good return, right? Your in 7 years, that $100 will become $200 if you can compound it at 10%. So present value of the cash flow, $1 billion, right? Let me make it pretty, yeah. So what I'm going to do is I'm going to take this cash flow and discount it by this, right? So what I'm trying to do is this 1.1 is basically the 10%, right? So you have to divide that with 1.1 and then power to 1. And what 1 signifies here is the year 1, right? So the first year is equal to 1, and that's the discount. So you saw that like the value decreased a bit. So that's the real value, right? After the discount and after taking into account this 10%. And now for year 2, what I'm going to do is these calculations actually are not, doesn't need to be very precise to the decimal point. You just need to have an estimate, right? Now it will be 2. The year will be 2. See, $25 billion became 20 billion because everything prices are increasing and you need a good return to match that. Now you will do 3 like this. We do all these numbers and then 4, and then this divided by 1.1 power 5, this divided by 1.1 power 6, this divided by 1.1. The good thing about this approach is if you are conservative and still see the stock is at a discount, then it's a great indication that you are going to make good amount of money with good security uh, of like not losing the money. I forgot the year. I think it is 9. Let me check. So this was 8. Yeah, this was 9. This was 10. Because the most important part about investing is safety, right? So if you invest, say, $100 into a stock, you shouldn't lose the $100, right, over the years. If you lose the $100 like a permanent loss, then I'm sorry, like then that money is gone. That's like a opportunity loss. So we have to be conservative and then buy things at a discount so that even if things turn out bad, we are not going to lose our principal, right? And in the long run, we are going to make a lot of money, right? So it's discounted now at 10% for for 10 years. Let's do some total of this cash flow because that's what it counts, right? So we are going to do a sum of this, and that's a good amount, right? $1 billion. That's interesting, right? And now there is more, right? So this is basically our projection of what the bank is going to make and then discounted at like 10% in 10 years. And then if we are buying this bank, right, like if we have, so the bank is currently trading, as I said, at 220 billion. So it's very close to whatever cash it is going to produce in 10 years. That's a pretty good investment. In 10 years, you can recover all the money that you have put into this bank. And if you still have the bank, so that's amazing. But let's say, so there is more. right? Not just this. So then you have to go to statistics here under Bank of America, and you will see if you scroll down that it already has quite a bit of cash, right? And then it has quite a bit of debt too. But like if you like remove, because it's a bank, right? So you have to pay this, right? Some like deposit and stuff. So that cash minus this debt will be available cash, right? Which will be around $400 billion. So that's like a good amount of money because that is already there as of today, right? And let's say you held this bank for 10 years, right? And the bank is making money and all that thing. At the end of 10 years, you want to sell this bank. And let's say this bank is trading at that time at 10 times of its basically, or let's say it's, yeah, let's say it's trading at what, like 10 times of its basically cash flow, right? Which will be, so I'm going to make a mark here. Let's say the bank at the end of 10 years is trading at 10 times cash flow of 2030, right? So let's make it more, yeah. So that will be, so 10 times this, right? So that will be this cash flow into 10. So that's that. Now what we have to do is we have to discount this to current value, right? Like the thing that we did. So it will be the to the power of 10 because this is the 10th year, right? So this will be divided by 1.1 power 10. Once you do that, it gives you again $230 billion. And now the total, right? So the intrinsic value is the total cash that you can take out of a business in a certain period of time, right? So the total cash that we can take out of Bank of America in 10 years, discounted at 10%, will be intrinsic value of BAC will be sum of these three cash, right? So this plus this plus this. So that is going to be this plus this plus this. So that's that. And now what we can do is we can divide this intrinsic value by the number of shares that are available and see per share intrinsic value, right? So intrinsic value of BAC per share will be, so if you go here into the statistics again, so we'll click on the statistics and then we go down, we have to shares outstanding, right? So this is the one. So this shows 8.66 billion shares. So what we have to do is we have to basically take this, divide by 8.66. Billion will get cancelled, right? Billions of shares and billions of dollars. So billion gets cancelled. You will get a dollar amount. So dollar per share. So this is the intrinsic value of Bank of America as of today. This is amazing, right? So this roughly it's like 98, let's say it's $100 per share. And now if you go back up here, right, and you go and you see that bank is trading at $25. So this is trading at a much lower value than what it is worth for. So I think this is a very highly undervalued right now. And what happens in markets is over time, the share price meets the intrinsic value of a company, right? So if Bank of America's intrinsic value is $100, right, taking all the cash into account, eventually, like 2 to 4 to 5 years from now, the bank will be trading at $100 per share. The market will recognize that and then the prices will increase. All we have to do is invest and wait. Wait for the bank to go there. So that's amazing that we can calculate that just based on high data from Yahoo Finance and Excel, right? So, and I think we have been enough conservative, but Bank of America, I think, is going to grow much faster rates. And the reason for that is like you see, like Wells Fargo here, and if I see asset cap, right? So, Wells Fargo asset cap, you go to the first link, like whatever link comes up. In 2018, the Federal Reserve in the US has put 220 billion like an asset cap on for Wells Fargo. What that means is like Wells has been asked by the Federal Reserve to only take deposit up to 1.95 trillion, right? So they cannot, like, even if someone goes there to the bank and the bank is has already taken 1.95 trillion dollars for the year, they cannot accept the money. And if you think about it, it's kind of funny because if the bank cannot accept the money, how the bank is going to lend the money and make more money out of it, right? That's how the bank works. They take your deposit, then they give out loans, and then in that spread, they charge interest. They basically make money. So what are these customers going to do, right? They are going to go to the other banks like JP Morgan Chase or Citi or Bank of America, and those guys don't really have any asset cap on them. So I don't know how long this asset cap is going to stay, but it is still there. But even if it stays for 3 to 4 years, 5 years, let's say, Bank of America and all the other these banks are going to steal away a lot of customers from Wells Fargo, and that's where they can make more money. So that's pretty interesting. So I think that's the I want to end the video here. I hope you learned something and you can do your own research more on this. I'm going to upload this Excel file so that you can follow along with the video, and I'll give the Yahoo link and the macro trends link onto the video. If you like the video, please check out my other videos and hit like or subscribe. Thank you for watching.